What we're seeing at the moment, Elijah, is the 10-year yield is at 1.7%, and the market is getting really, really nervous.
Physical silver and gold in your hands. Personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com. Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update. And back with us today, one of our viewers' favorite guests, Ronnie Stoeferle. He is the fund manager at Incrementum AG, and he is also the publisher of the very popular In Gold We Trust report. Ronnie, thank you so much for joining us today.
Hi, Elijah. Thank you very much for saying my name almost perfectly. It's I'm used to. We said it before. Most people are just butchering my last name. It's pretty complicated, but you did really well.
Well, thank you, and yeah. So really, why I wanted to have you on is kind of to give an update on the precious metal sector. Last time we had you on, you were really you saying that your latest In Gold We Trust report was all about that a new decade for gold is dawning, right? A new golden decade is dawning, and you have some price targets you're looking for in the precious metal sector. You're looking for $2,300 gold, and also a gold-silver ratio around 50-1, which would put silver at all-time highs. So can you expand on why you're so bullish right now, and really this year you think gold and silver could really take off?
Well, actually, we wrote 360 pages about gold last year and laid out our bullish case, and we are currently writing on the 2021 edition, which will be published on 27th of May. So stay tuned. In Gold We Trust 2021 will be published soon. I think, I always ask people that recently became bearish on gold and say, do you really think that we would actually survive through an environment with significantly higher interest rates, especially significantly positive real rates? What we're seeing at the moment, Elijah, is the 10-year yield is at 1.7%, and the market is getting really, really nervous. So I can really feel from many market participants, from clients, they keep asking me, well, when does the Federal Reserve actually start yield curve control? Now we had Jay Powell speaking this week, and he didn't even mention the big word tapering. We remember in 2013 the big taper tantrum under Ben Bernanke, and I think now, if we would really see some sort of tapering in the market, it would cause a dramatic correction in the equity markets, probably also in the commodity space, in basically every asset class. So I think it's a highly interesting environment. Of course, this 1.7%, this was quite a lot of a headwind for gold. Now, on an absolute level, 1.7% doesn't sound like a lot, but we have to remember when gold did hit an all-time high in August last year, the 10-year was trading at 0.4%. So from 0.4% to 1.7%, that's a pretty large move. And of course, inflation expectations are rising, but they don't rise fast enough. And market participants are seeing inflation on the short term, but for the longer term, I don't see any big fear of inflation yet. So long story short, from my point of view, basically every central bank on the globe is in a zero rate trap. We simply cannot afford higher rates. We cannot afford positive real rates. We will see much more interventionism. We're actually seeing now that the US economy is doing much, much better. I think that most of the the COVID uncertainties, they're getting priced out. Actually, now would be the time to become a bit more restrictive, a bit more hawkish, taking the punch ball away. But as we have seen with Jay Powell, they're super scared of doing that. They're scared of another taper tantrum, and they will keep the party rolling. And I mean, I think basically every asset class, if it's commodities, if it's the equity markets, if it's real estate, if it's the art market, whatever, is already telling us that inflation is getting out of control. In fact, Ludwig von Mises would have called that the beginning of a crack-up boom. So long story short, I think when it comes to gold, the sentiment now is extremely bearish, especially compared to the sentiment that we saw last summer. We're seeing that the commitment of traders report is getting more and more positive. And from my point of view, from a technical basis, I think we have seen the lows, that there is some pretty solid support at the 1670, 1680 level. So from my point of view, the worst part of the correction is over.
You mentioned Jerome Powell's statement regarding what the Fed is going to do. And here's just a quote from what he said in the press conference. He said, "We will continue to provide the economy the support that it needs for as long as it takes." So to me, that seems extremely bullish for gold. And it's like, okay, we're going to do this for as long as it takes, you know? And even though the economy seems to be recovering a bit, even though the vaccine is rolling out and it seems like back to normal, this transition back to normal seems to be, we can see that on the horizon. The Fed is still saying, yeah, we're just going to keep doing this easy money policy for as long as it takes. So what is your perspective on that? It seems like that is extremely bullish for gold.
It is. I think, if you compare it, the Federal Reserve and basically all central banks, they're acting like the police department, raising the speed limit to 200 miles an hour and telling you, you can drink and drive. That's totally fine. Nothing's going to happen. But then, of course, something is going to happen. Perhaps it starts snowing or whatever. An accident is going to happen at some point. So I think this is a very dangerous environment that we are seeing. But we should not forget to talk about fiscal stimulus. And this is, from my point of view, the big difference compared to 2008, 2009. Back then, we saw unprecedented actions by the central banks. They introduced QE, quantitative easing sounds really sophisticated. Nobody knew what it was. And it's somehow worked, at least for asset price inflation. But this time around, we're seeing massive fiscal stimulus. We saw stimulus rounds last year already. Now we've got those 1.9 trillion additional stimulus. Then we've got the Treasury General account at 1.8 trillion. Where they said they will run it down. So this will be additional stimulus. And I think this symbolic character that Janet Yellen is now the Treasury Secretary as a former head of the Federal Reserve. This is really unprecedented, and we're seeing that fiscal policy and monetary policy are working together much, much more closely. Similar thing in Europe. Over here, we've got Mario Draghi, former head of the ECB, now the prime minister in Italy. So I think this is telling us it is not only monetary policy, it is monetary policy and extremely aggressive fiscal policy. Now, helicopter money, MMT, universal basic income, stuff like that. 2 years ago, that was really something for, left-wing economists sitting in the ivory towers. Now this is becoming mainstream, and this is that's indeed a big concern from my point of view, because we're really far away from capitalism, from free markets, and we're getting used like Pavlovian dogs to this permanent stimulus. But on the other hand, of course, that even makes the case for gold more positive. Now, Do I think that inflation will be the big topic over the next couple of years? Yes, absolutely. I think we published a special report on inflation. It was called "The Boy Who Cried Wolf," and I think that, I mean, it's no secret that central bankers want more inflation, and actually they openly tell us we are gonna let we will let inflation numbers overshoot. Now this is happening, and people still don't really believe that they're gonna achieve it this time. However, I think that they will have a hard time when inflation runs at 3, 4, 5% to put the genie into the bottle, or as a German central banker once said, if the toothpaste, once it's out, it's hard to get the toothpaste in again. So that will be one of the major topics going forward. And a client of ours, he told us, well, inflation, that's already so much of a consensus trade. And I said, well, perhaps in the media, but if I look at positioning, I didn't see any major inflows coming from, institutional players like pension funds, like insurances, big asset managers. They didn't really allocate a lot of capital into the commodity space, into tips, into precious metals. So I think in the media, it's becoming more and more of a topic, but nobody has realized that this is happening now. Just one number: the average investment advisor nowadays is 54 years old in the US. So he basically never worked in an environment of inflation or even stagflation. So they've got no clue how to position portfolios in an inflationary environment. And this is, I think, this paradigm shift that we're currently seeing, which is extremely interesting to follow.
You mentioned regarding the merging between monetary and fiscal policy, and I think that's really a key point, because you mentioned how it's a distinction between the crisis we've seen with COVID and in 2008. And correct me if I'm wrong in kind of this analysis, but what we saw in 2008 and going forward beyond that was that the Fed was essentially soaring up banks' balance sheets with cash, right? And that's kind of what the stimulus was. That's what the quantitative easing was. But the cash was just sitting there. It wasn't doing anything. What we saw in COVID was a lot of money being pumped out to individuals, right, to spend right away. And we're seeing that with the stimulus, the $1,400 checks that are going to come out. And that is a completely different situation, because then that gets the money directly to the people, right, and the individuals to spend, which then makes, if the economy starts moving again, which it looks like it is, the vaccines are rolling out and everything, then we're going to see money velocity increase, and that will actually impact inflation. Is that correct? And what is your perspective on that?
Yes, I mean, last fall, I think I had a call where Mark Bristow, the head of the CEO of Barrick Gold, was on, and we were talking about the vaccine, and the question was, once the vaccine is out, won't this be, the end of the bull market in gold? And my analysis was that short term, of course, this will be negative, because the worst is over and there's light at the end of the tunnel and so on, and there will be some sort of a rotation into other sectors. However, I said that from my point of view, now the big problem that we are still facing is this high level of uncertainty. I mean, over here it takes a bit longer with rolling out the vaccines. I think in the US you're quite a lot ahead. But in this moment or period of uncertainty, nobody is really willing to make any big investments. You cannot make any big plans. Traveling is kind of restricted. So this uncertainty, of course, leads to the fact that people are saving money. But once this is over, I think everybody will try to compensate for the things that he missed during the whole lockdown seasons. So people will go crazy. They will go to the restaurants. They will party. They will make fancy vacations. They will spend money. So I think this will be the point in time when velocity really starts rising, and rising velocity will meet an enormous amount of capital, enormous amount of liquidity that was created over the last couple of months. So actually, I think now would be the time to become more restrictive. But as we have seen recently with basically every central banker, they continue to be extremely dovish. They say, well, we won't change anything. We will continue to support. And the problem is they completely underestimate the time lags. So this basically confirms my view, and therefore I think the analysis that I made last fall before the vaccine, where I said, okay, once the vaccine is out, velocity will bottom out and will start rising, and this is exactly what's happening at the moment.
Billionaire Bill Gross is saying that we could see inflation at 3 to 4% within a few months, and he's actually shorting bonds right now. This is from a Markets Insider. What is your perspective on that? Is that kind of a high target within a few months, or what kind of rates or what kind of inflation rate do you see happening this year?
No, well, actually, just due to the base effect, inflation numbers will rise quite significantly over the next couple of months. So 3.4, even 4% are definitely possible. Of course, the central banks, especially the Federal Reserve, will then say it's only transitory because of this base effect. But I think there's also many more structural things to consider when it comes to inflation. It is not only this combination of aggressive fiscal and monetary policy. It is stuff like MMT, helicopter money, and so on. We shouldn't also forget talking about demographics. We're also writing a piece about that for our upcoming In Gold We Trust report. And we should have a close look at China. Inflation also was so low because China was exporting deflation around the globe over the last couple of years. And we shouldn't forget, in 1994, China depreciated the yuan by 50%. If you have a look at what happened since then, the power of the Chinese labor force was unleashed to the whole world, and deflation was exported to the whole world. Now, from my point of view, if you have a look at the Chinese renminbi and how it has moved recently from 0.14 to 0.153 to the US dollar, that was a pretty significant move. And if the renminbi should continue strengthening, then this will also add to this inflationary environment. So I think it's really lots of different factors that influence our inflationary outlook, and I think it's like a big pendulum, and it's now swinging really into the direction of more inflation, while over the last couple of years the deflationary forces or the disinflationary forces were still slightly stronger. But we shouldn't forget, we have already seen massive monetary stimulus. We have already seen massive asset price inflation. And now the next step would probably be at least according to Austrian economics, price inflation, consumer price inflation. And the interesting thing is, this is exactly what central bankers keep telling us. Inflation numbers are too low. We want to see inflation numbers higher. So this is the reverse Paul Volcker. Back then, Paul Volcker basically killed the bull market in gold because, he decreased the monetary growth dramatically. It caused a massive recession in the United States. The dollar strengthened and so on, because his job obviously was to end inflation. Now central bankers are telling us exactly the opposite. So I think I cannot imagine a more positive environment for gold.
Last time we had you on, you mentioned how the wealthy were actually moving into gold. We were seeing a few very wealthy individuals moving into gold. Recently, in the last month and a half or so, we've seen a lot of the public moving into precious metals, especially silver with this whole SilverSqueeze phenomenon. Which do you think is more impactful to the price of precious metals? The wealthy saying, okay, actually, yeah, precious metals are the place to be, or just the general public, kind of that populist movement in a sense, moving into precious metals as an asset to, be outside of the system?
Well, regarding the whole SilverSqueeze thing, I honestly, for me, it was a bit difficult to follow because I think that people should invest based on fundamentals, and they should understand the supply demand picture and not just rush into something and try to short squeeze it. So from my point of view, I like the fact that silver was in the on the center stage again for a while. But I think that I would have appreciated if the information was perhaps a bit better and more nuanced, and people would really invest based on their conclusions. But that's just my view. When it comes to investment flows, over here, I think, last year we saw really big inflows from institutional players. So into the ETFs, we saw 877 tons, which is roughly 50 billion US dollars. So that's quite a big move. In the fourth quarter, that cooled down slightly, but I think this is really, really a big trend. I'm really seeing over here that institutional players are kind of rediscovering gold. And those are not the super big players. It is, smaller and mid-sized wealth managers, family offices, and so on, because they understand the big picture, and they know that real rates won't be positive over the next couple of years, and this should provide a really good tailwind for gold. So this is really what we're seeing, more and more institutional players constantly adding gold positions to protect their portfolios in a negative rate environment. What's interesting at the moment is, if you have a look at COMEX gold deliveries, they are extremely strong. We've seen in February of this year, we saw 36,000 deliveries, which is 113 tons, physically delivered. That's 5 times the average amount. And the March contract also looks very interesting. So it seems that people really want the real stuff. They want the physical gold and not the paper contract. That's pretty interesting. But I think when we talk about the longer term drivers for gold, we shouldn't forget in 1989, I think, China and India were responsible for 10% of the whole gold demand. Last year, it was 56%. So gold is actually, it is much more of a Asia story, of an emerging market story. And why? Because, in India, in China, people know how it feels to live with a weak currency, to live with high inflation. If you talk to people from Turkey, for example, for them it's just normal to hold gold as a big part of their asset allocation, because they are used to a very weak Turkish lira, to high inflation numbers. And I think this development is something that we might see in the Western world at some point too. So that makes me pretty confident. And just one last thing, I think we shouldn't become too greedy. Gold was up 25% last year. It was a pretty good performance. Gold perfectly did its job. It was the defender in your portfolio. what's the saying in American football? Offense wins games, but defense wins championships. And I think, in these highly volatile weeks of last year, we saw that equities were selling off dramatically. Gold initially sold off, but then it recovered very, very quickly. So it acted as a portfolio stabilizer. And this is just what you want to see in your portfolio.
With respect to kind of gold and silver, you mentioned really focusing on the fundamentals, right? The fundamentals to own precious metals. And I think that's one of the things that has been highlighted over and over. Some people say, well, this SilverSqueeze failed in a sense. And some people would argue against that, right? But at the end of the day, does it matter, right? What were the original reasons for owning precious metals? Those haven't changed. Right. And I think that's a really good point. And it kind of should transition to our last topic I'd like to discuss. You've mentioned, this was back in January, that compared to the physical metal, miners are actually looking very inexpensive. Is that still your view? And why do you say that?
Well, actually, just today we ordered some. We increased our positions in some of the big names again. So I'm just seeing incredibly attractive valuations. I'm seeing pristine balance sheets. I'm seeing high free cash flow yields. I'm seeing that the companies really did their homework in the bear market. They got their balance sheets in order. They wrote off projects. They got their costs under control. And, last year, I think I did more than 100 meetings with companies from the mining space. And most of those meetings were really impressive. Yeah, the companies are really making money. It seems that they are pretty conservative when it comes to their gold price forecast. So most of them, they have like an estimate of 13 to 1400. So they don't need gold prices at 2000 to make profits. We're seeing some developments on the M&A side. With Equinox and Premier Gold, but also GT Gold and Newmont Mining recently. So I think it's really an attractive sector. And after this parabolic move in summer, I think it really cooled off dramatically. Now at the moment, I'm seeing really interesting entry points. And I think most of the numbers that were published recently were really beating expectations. So producers are expanding their margins, dividends are being raised, valuations are just really, really attractive at the moment. So I like the sector a lot.
All right. Well, Ronnie Stoeferle, thank you so much for joining us today. Before we let you go, if people are interested in hearing more of these interviews, please hit the subscribe button and the bell icon so that you'll be notified when all these new interviews are being released. And if people would like to find you and your In Gold We Trust report, where can they find you?
Well, ingoldwetrust.report is the domain of our fund. We can download all our reports for free, our inflation report, The Boy Who Cried Wolf. If you want to look at our products, our investment funds and so on, incrementum.li. And I'm also pretty active on Twitter. My handle is @RonStoeferle.
Fantastic. Any last thoughts before we let you go?
No, actually, all good. I hope that all of your listeners or viewers are healthy. I had the pleasure of dealing with COVID. It's definitely more than just a little flu. It was pretty tough, but now we're back, and 27th of May is the big date. So mark your calendars. That's the release date of the new In Gold We Trust report.
Definitely. Well, we'll be looking forward to that, and I'm glad you're doing better after COVID.
Thanks.
So thank you so much, and God bless.
Thank you very much. All the best. Take care.
Physical silver and gold in your hands. Personal service, competitive prices, and zero complaints. That's Miles Franklin. Call us at 1-800-822-8080 or email us at info@milesfranklin.com.